Hi, this is Jessica Dunn, and today we're going to talk about the goal of a firm. The goal of a firm is to maximize shareholder wealth. So, if you're a financial manager and you're facing a financial decision, you should always weigh the risk and return and ask yourself, will this action increase share price? And if it does, then you should accept, and if it doesn't, you should reject. Because financial managers work for shareholders. Shareholders are the true owners of the firm. Um, we do need to balance our risk and return, but the main reason why we're focusing on shareholder wealth and not profit is because profits are vague. Are we talking about long run profits or short run profits? They could be subject to manipulation. Maybe you can switch accounting methods from LIFO to FIFO, or change your depreciation schedule. But we should back focus on share price, maximizing share price as a method of maximizing shareholder wealth, because share price is determined in financial markets with regulators and massive groups of buyers and sellers, so that it's less subject to managerial manipulation. But there are three factors to consider: timing, cash flows, and risk. Timing is important because the receipt of funds now is better than later. So we prefer now as opposed to later. Cash flow is important because even if a company makes a profit, that doesn't necessarily result in cash available to shareholders. That cash could be retained and reinvested, or it could be used to pay shareholders. And risk. Profit maximization does not account for risk. Shareholders are risk averse and they must be compensated for bearing any risk that they're exposed to. So let's break these down. Let's first look at timing. We said that sooner is better than later. And so here we have two possible investments. We have a rotor and we have a valve. We see that for the rotor, it's going to have earnings in year one of $1.40, in year two of $1, and in year three of 40 cents. So it will have a collective return of $2.80. The valve returns 60 cents in year one, $1 in year two, and $1.40 in year three for a collective return of $3. So I'm not saying that one is better than the other, but it is important to look at the timing of the cash flows. Here we see that the rotor returns 50% of the cost back to you in year one, whereas the valve has total aggregate earnings greater than the rotor, but it takes longer to receive those cash flows that you invested. So I'm not arguing that one is better than the other. It is just important for you to look not only at the magnitude of cash flow, but how that cash flow is dispersed. So it could be that the rotor ends up being a better investment than the valve because you're receiving those cash flows sooner, earlier in the project's life rather than later. That's going to depend upon your discount rate, which we're going to get into later. Cash flows. So let's look at a scenario. We have a company that is selling a yacht. They sell a yacht for $100,000 that they originally purchased for $80,000. The company paid for that yacht this calendar year, but they sold it on credit and still have not received payment of $100,000 at year end. So from an accounting perspective, so let's look at it from an accounting perspective. We have our revenue of $100,000 minus our cost of goods sold of $80,000. So we made a profit of $20,000. But when we look at this from a financial perspective, let's look at cash flows. In finance, we're always concerned about cash flows. It doesn't do any good if you make a profit and can't keep your electric bill paid. So here we have inflows. So our cash inflows are zero. We haven't received any payment from the sale of this yacht. outflows, we spent $80,000. So our net cash flow, negative $80,000. So yes, we technically made a profit, but we may not be able to pay our electric bill at the end of the year. So another factor to consider is risk. So let's look at two different scenarios. We have a $50 investment that has a 50-50 chance of being worthless in 1 month, so the value is zero, or being worth $100 in 1 month. So it's a double or nothing kind of thing. You put in $50 and you have a chance of doubling it or it being worth nothing. So the expected return on this investment is $50. And we'll get into later how you calculate expected return. But it's simply the cash, the possibility of earning that cash multiplied by the amount. So we had a 50% chance of nothing plus a 50% chance of $100 gives us an expected return of $50. But let's look at the risk of this. Let's look at a rudimentary measure of risk. Let's look at range. So here we have the possibility of receiving $100 and the possibility of receiving $0. So we have a $100 range in payouts. Let's look at scenario B. We have a $50 investment that has a 50% chance of being worth $60 in 1 month and a 50% chance of being worth $40 in 1 month. The expected return is still $50. But the range on this investment with 50% chance of 60 and a 50% chance of 40, it's only a $20 range. So this investment, as this second investment in the blue box, is much less risky, and typically less risk is preferred. But what about stakeholders? So we've talked about how it's important to consider your shareholders and to maximize your shareholder wealth. But what about those stakeholders? Stakeholders are groups such as employees, customers, suppliers, creditors, and owners, and anyone else who has a direct economic link to the firm. These are people who are affected by the actions of the business. A firm with a stakeholder focus consciously avoids actions that would prove detrimental to stakeholders. The goal is not to maximize shareholder well-being, but to preserve it. Such a view is considered to be socially responsible. We do need to consider ethics. Ethics are the standards of conduct or moral judgment that apply to persons engaged in commerce. Violations of these standards in finance involve a variety of actions, including creative accounting, earnings management, misleading financial forecasts, insider trading, fraud, excessive executive compensation, options backdating, bribery, or even kickbacks. These often result in negative publicity. This negative publicity is going to have a negative impact on share price, which brings us back to rule 1, don't do anything that doesn't maximize shareholder wealth, which we measure from share price. So if you don't act in an ethical way and people find out about it, your share price falls, which destroys shareholder wealth. So from that first rule, you should always be ethical. Robert Cook is an ethicist, and he suggests that you should answer these questions before you take any action. So first, is the action arbitrary? Does it unfairly single out an individual or group? Does the actions affect the morals or legal rights of anyone? Does the action conform to accepted moral standards? And are there alternative courses of action that are less likely to cause actual or potential harm? So a good ethics program is going to seek to reduce litigation and judgment costs. It's going to help maintain a positive corporate image. It's going to help build shareholder confidence, and it will gain the loyalty and respect of all stakeholders. The expected result of these good ethics programs is to positively affect share price. So if we think about companies that have a strong ethical program, we think about companies like Google. Their motto is "Don't be evil." It's not enough to run a successful business, but they want to make the world a better place. Another notable company we often think about would be Starbucks. Their model is to inspire and nurture the human spirit. They want Starbucks and everyone they touch to endure and thrive.